are live. So welcome, and I'll call to order the regularly scheduled meeting of the Kentucky Retirement Systems Investment Committee. We do have a quorum. Welcome to everyone, and thank you for attending. Vicki, you want to do the opening legal statement for us?
Yes, sir. This is the regular meeting of the Kentucky Retirement Systems Investment Committee. This meeting is being broadcast via video teleconference pursuant to Kentucky Revised Statute Section 61.826 and may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road, Frankfort, Kentucky. It is also being broadcast to the public via Facebook. If you are speaking and not appearing by video, please identify yourself before talking. Please ensure that you are on camera when making or seconding a motion or casting a vote. In the event the video or audio broadcast is interrupted, we will attempt to reestablish a connection. If a connection cannot be reestablished within 30 minutes, the meeting will be adjourned and rescheduled to another date.
Thank you. And Sandy, would you do the roll call for us, please?
Certainly. Mr. Lane,
Here.
Mr. Atkins,
Here.
Miss Bova,
Here.
Miss Thompson.
Here.
Thank you. That's everybody.
We got a full team here today. I understand there's no public comments.
That's
So
correct.
we can move on to the minutes of the previous meeting. Any comments or adjustments that would need to be made?
Move approval.
Second.
I think we have by acclamation, we have approved it. And I don't think we need a vote on it. So the minutes are approved as submitted. Thank you. And so the first item of business is an interesting one. I'm very excited about this one. We had our staff has been doing a lot of work and has come up with what I consider to be one of the, and this is editorially, I'm not voting yet, one of the premier investment firms that I'm aware of. And some of you are aware of me sending out missives from Oaktree and particularly the founder of it, and who's, I think, one of the brilliant people in our industry. So I'll move this over to the investment staff to present. And
thanks, Pruitt. I'll take it from here. Sandy, I'll start on PDF page 11, please. Thank you. KPPA staff and Wilshire are recommending replacing our current bank loan manager, Shinkman, with Oaktree Capital Management for all KERS and SPRS portfolios pending successful contract negotiations. The bank loan mandate is held within a specialty credit allocation, and the recommendation is for an investment of up to 25% of each portfolio specialty credit target allocation. The recommended change keeps the bank loan asset class within portfolios while improving performance consistency and risk management. This report serves as a review of the competitive open search process in accordance with the investment policy statement, the investment procurement policy, and as the investment recommendation to the investment committee. Placement within the portfolio, as I mentioned, the bank loan mandate is held within the specialty credit allocation with exposure to senior secured floating rate loans. You can see the 9/30 market values for the mandate, the percentage it represents of the specialty credits, and the percentage of the overall portfolio for each plan. Implementation and portfolio sizing. The recommended structure is a separately managed account managed by Oaktree, representing up to 25% of each portfolio specialty credit target allocation, with each portfolio maintaining its current size and exposure during transition. For the transition, staff will work with Oaktree and Shinkman to minimize transfer costs, whether that's assets in kind transfer, cash, or a combination. The benchmark will be the Morningstar LSTA US Leveraged Loan Index. In terms of management fee, Oaktree requested a redaction for the public meeting, but committee members should have a non-redacted version in front of them. Based on the initial funding size of about, excuse me, of about 370 million across both pension and insurance, the rate is extremely competitive compared to the universe data supplied by Wilshire and rates posed by other managers in the search. And speaking of the search process, the search was started due to disappointing net performance and a desire to steer the mandate towards a pure play bank loan approach. We started with Wilshire's U.S. bank loan universe and focus list. After review and screening, we sent an RFI to candidates, including the current manager. A quantitative assessment was conducted, and at this time, I'll turn it over to Ian to explain the analytics.
Sure. Yeah. Thank you, Brian. Good morning. From a quantitative standpoint, our goal was to find managers that were able to deliver strong, consistent, absolute and risk-adjusted returns with a particular focus on the ability to outperform in down markets, and then also to limit drawdowns. So to reach our finalists, we ranked the 8 candidates based on the performance measures listed in the memo, and then we weighted the results. The final scores yielded the 3 managers, which we consider to be high conviction candidates since they demonstrated strong, consistent, absolute and risk-adjusted performance, as well as strong downside protection. So just turning to the slides here on page 14, please. This shows the returns versus volatility of those returns across various time periods for the bank loan universe of managers. These managers that are in the upper left quadrant of the charts scored highly in our assessment because they were able to deliver above average returns with below average risk. Turning to page 15, you can see the information ratio for each of the 8 candidates compared to the bank loan universe. So if you exclude our current manager, the remaining candidate pool scores in the top half, with the 3 finalists, Oaktree, Ares, and UBS coming in the top quartile across the 3 time periods considered. And then lastly, on page 16, this page attempts to capture a manager's ability to deliver consistent returns across various market environments with the particular focus on relative performance in down markets. So ideally, you want one of these bubbles to be, top and left of the index bubble. You want it to be small relative to the other bubbles, which means that it has a smaller, max drawdown. And then you want it to be shaded blue or gray, which means that it's basically been better or 60% better at outperforming the benchmark during those time periods. And so you can see that our 3 finalists exhibit those characteristics. And
Yeah.
I'll turn it back to you, Brian.
Yep. Thanks, Ian. Ian was a big part of this project, and I just want to thank him for all of his work on this. It was very helpful. And based on that analysis, as Ian said, we had 3 finalists, which we selected for further due diligence meetings. And after team interviews and discussions, Oaktree emerged as the preferred manager based on risk discipline, performance, team structure, and cost efficiencies. In accordance with the gating practices, staff requested Oaktree to acknowledge transparency requirements and complete a conflict of interest statement and placement agent form. Copies of those forms are attached and will be part of the contract negotiations. No placement agents have been involved or will be compensated as a result of this recommendation. And I'll pause for any questions at this time. Otherwise, I'll let Wilshire add any comments if they have any.
Brian, was there any conversation or what was the conversation about the recent sale of the remaining piece of Oaktree to a private, well, not a private equity, but another
Brookfield.
Brookfield.
Yeah.
Yeah, that recently took place. Before the final version, which was recent, there was already 75% was owned by Brookfield. The remaining 25% was just completed a few months ago. So there's no issues or concerns from that standpoint.
Okay.
Just want to add from the Wilshire side, as Brian said, in addition to a few candidates that he and Ian had identified, largely looking at the highest rated loan managers in our qualitative rankings. So all the finalist firms had a second decile rating. So from a qualitative perspective, a slight improvement from your current manager, and then as Brian and Ian walked through quantitatively, an improved risk return profile. And just want to reiterate, as Pruitt saw, as you were part of that final interview, I think the staff ran a very thorough process here, from reviewing 8 lengthy RFIs to using quantitative and qualitative assessment to narrow it down to 3 candidates, further 3 interviews, and a final interview with staff and some IC board members. So took about 6 months, I think, from start to finish, right, Brian? And
Yep.
a lot of work went into it. So a very solid process in our perspective.
Brian, was there any a consideration whether there could be additional economies of scale if the CRS board were to be involved in this?
The current fee structure that was proposed to us was a combination of all plans on both the insurance and pension side of things. So if there was a difference split, that fee structure would be different.
But am I correct that you said the other day in the meeting that the fee is lower than Shankman's?
Yes.
And that was a big part of the discussion and negotiations, because we're looking at an asset class where top managers we think will produce maybe 50 to 100 basis points of value add. So from your current fee structure to the new proposed one, assuming K and C both approve and the mandate reaches the dollar amount that we think it will, you're shaving over 10 basis points off that fee. So that 10 basis points relative to the amount of alpha we're expecting here is really considerable.
Yeah.
Any further questions? And I know we don't have this asterisk for a vote. Do we need to actually go do a roll call vote for approval?
Yes, I would ask the committee to vote for approval of Oak Tree Capital Management, subject to successful contract negotiations, and send to the board for ratification.
Well, I will make the motion that that Oak Tree be retained pending successful negotiations and legal and approval, et cetera.
And Mr. Chairman, if I'm correct, what we're doing is making a recommendation to the full board? Or is our action here binding?
The action's not binding based upon the board bylaws, which says that the board must ratify any action of the investment committee.
So we're taking the staff recommendation and we are forwarding it favorably to the full board.
Correct.
That's correct.
Yeah. Okay.
So a second out there?
Second.
All right. I think on a matter of this, we probably should have a roll call vote. So Vicky, do you want to do that for us? Or Sandy?
Sandy will.
Sandy.
Mr. Lane,
Yes.
Mr. Atkins,
Yes.
Ms. Bova,
Yes.
and Ms. Thompson.
Yes.
That's complete.
Thank you all very much, and thank the staff in Wilshire for this with this quality work. And we'll, as I say, I'm very biased in favor of this firm's many years. I've known them and the success, so I think they'll be a great addition to our team of managers.
Thank you.
So that is now approved, or we'll go to the full board. And I think we have a presentation from the staff and Wilshire on the performance benchmarks.
We do. This is David with Wilshire. I can kick that off. And if we just go over to the next slide, I'll walk through this. The background is that you've all heard Steve and Anthony and us talk for a number of meetings about coming up with a better benchmark for the private equity investments. And so we'll present today actually sort of a challenge that you all have, and it's similar to the challenges that other institutional investors face. What does everyone do about this? And then there are some solutions. And so we'll just kind of walk through that today and talk about what the challenge is, and then a solution for you and something to consider as a recommendation. But the two areas of challenge are with private market investments. First of all, is how do you integrate that performance with your total fund? And I'll talk in a minute about why that's not easy to do. But somehow, if you have 5, 10, 15, 20% invested in private markets, that needs to be able to, we often refer to it as rolling up. It needs to roll up into the total fund performance. So that's one area of challenge that's not unique to Kentucky. It's it's a challenge faced by all institutional investors. And the second thing is just how do you appropriately measure the success of that private markets program? So that is much more doable. And we actually, you have a process in place already, and we prepare that for you in the private market reports. So that's doable. And that's really not, to measure the success of the private equity program is not hard to do. Problem is to integrate it. So the reason it's hard to integrate is when you think about the total fund performance, when you look at the top line returns, 1, 3, 5 years, et cetera, that staff will present later today, those are a combination of all of your asset classes rolling up into the total. And where it becomes a challenge is that public market investments are all easily measured on what's called a time-weighted return basis. And that's because those investments have, they mark to market daily in the markets, as you know, because they're tradable. But private market investments, they don't really react well to this time-weighted methodology, because private market investments have very lumpy cash flows and very large. Their distributions or their capital calls going in. And so, if you spend any time in the private markets, you'd be familiar with the way those are measured properly is on an IRR basis. It's a dollar-weighted internal rate of return calculation. So we do that with you, and you're doing that in your private markets program, and you see that in the reports that are presented on the private equity, for example. But those can't easily roll up into the total fund. So what's happening today, you have the private equity portfolio is benchmarked to the Russell 3000 index plus 3%. And that is where the problem starts to exist, because when that rolls up, it creates a real challenge. And if we go over to slide 51, we just talk about this. Because we have this challenge with private markets, what are the solutions? Well, you can either use a time-weighted benchmark anyway and just deal with the consequences. So we'll talk about what those are. Or you can neutralize the effect of that roll-up issue. So we'll just take this, step at a time. But in terms of the biggest challenge is the relative performance. And I just think of a simple example. In fact, in your own performance report, if you look right now on a trailing 1 year, public equity markets are up like 18%, and your private equity portfolio is up 8%. That's not uncommon, because on a time-weighted measure, private equity investments are very long-term oriented. They don't trade daily at all. And in these short-term periods where public equity markets are either extremely high or selling off in a hard way, those are based on daily tradable market values, and your private market investments won't act anything like that. But the problem is when you benchmark the private equity portfolio in a time-weighted manner against something like a public equity benchmark or a public equity plus a premium, that has to roll up. And so in this example, and this is the challenge so many investors have faced lately, you could have in a 1 year snapshot a 10 or 15% difference between the public equity benchmark and what a time-weighted return would look like on your private market investments, because they probably haven't marked much during that trailing 1 year period. So if you think about a 10% gap there, and then that rolls up to the top of the fund, and if you have 10% allocations, say, to private markets, that's a whole 1% impact on your total fund performance versus total fund benchmark. So the problem is when this all rolls up to the top, and you as a board, a governing body, an investment committee, and everywhere else that you go that your returns are reported, you start to see this in these periods that are extreme. You start to see this impact. Your fund might look like it's underperformed its benchmark by 100 basis points in the past year, but that could all be attributed to this roll-up problem of the private equity benchmark, which isn't really a good calculation anyway. So this is a problem so many investors face, and we've thought about ways to deal with this. The second thing is when we prepare the attribution analysis of your total fund return. So these are in your performance reports, like the one that's in the book today. And those attribution reports focus on two things: the impact of your allocation to each asset class versus its target in the policy. And then secondly, the impact of the active management within that asset class. Well, when you have these periods of a public equity benchmark that is being used to benchmark your private markets so that it can roll up to the total fund, that also can totally skew this attribution analysis. So those are the problems with it. And I'll go to a table in a minute that shows, kind of the different options. But the thing that we'll talk about today is one way to solve this problem is to neutralize the impact of that roll up. And you neutralize it in a way by letting the benchmark for private equity just equal the private equity performance, only in one place, and that's in these time-weighted returns that roll to the top. And if you do that, then the relative impact, whether it's big positive or big negative, won't affect your total fund relative performance to the benchmark. It'll be neutralized. And what's important is that you can still be measuring the success of the private equity program. So I'll just talk through that quickly on the next slide. There are the three different options here on all of these time-weighted options in the first column. What many investors do is use a public market index plus a premium. The negatives on that are, first of all, it's not an investable benchmark. So right away, kind of the CFA rules and everything else, you can't invest in something that is public equities plus a premium necessarily. So it's not investable, but it has this big problem that I just spent time talking about. The public market volatility leads to exaggerated over and underperformance in this regard. And also, that makes it a lot of places for you. It makes it to the press. Your oversight bodies and all those things, they often get a glimpse just at the top line performance, and it's often affected in a big way that it really shouldn't be. So that's one of the options. Another option is some investors use private market benchmarks that they'll just, rather than a public market plus a premium, they'll use, there's three names here: Preqin, Burgess, Refinitiv. They'll use some of these other time-weighted benchmarks because it's a little more convenient. It's a little bit cleaner in how it can roll up. But those time-weighted benchmarks, they're also they're not investable. They're not indexes like you use in the public markets, where you could choose to invest in that index, or you could choose to have your actively managed portfolio. They're not that. All of those benchmarks in the marketplace are just collections of universe data of all the private equity investors out there. And those measurements don't even reflect how your portfolio is structured. So a lot of negatives with all of those. And then this neutralizing approach is the one that it solves the problem with this time-weighted roll-up performance. But it's important that if you do the neutralizing approach, you really need to accompany it with understanding what the IRRs are on the private equity portfolio so that you can monitor whether your private equity portfolio is paying off relative to having put that money in public equity markets. So it's kind of like if you neutralize, you need to attach it to this other process, which is easy for you to do because it's already being calculated. Just quickly on the next slide, we just did a collection of all of our clients in the different ways that they do it. And sure enough, you see this is probably somewhat reflective of the country. More than half of those are just using these time-weighted public equity indexes, and most of them at a premium, doing just what you do. And then they all have this problem. How does our total fund does well, but it looks like it's underperforming by 1% or 2% over the past year, and majority of it's coming from this private equity problem that sort of isn't really real anyway. So that's a dominant approach. 13% of our clients, we just did the math, are using these other private equity benchmarks like Preqin or Refinitiv that, like I said, it kind of makes it easier and cleaner, and they're available, but they're not investable benchmarks, and they don't reflect your program. 31% of our clients have moved to this neutralizing approach. So the key with the neutralizing approach is it needs to be understood, because if someone just looks at one page of your performance and sees public equity or private equity and the private equity benchmark is the same, they'll say, why are you not giving that any kind of a benchmark? So you need to understand what goes along with that. And what goes along with that is in the private equity program, if we can move to the next slide, please. The private equity program, you are regularly measuring that performance on an internal rate of return basis. We do that for you in the reporting of your private equity portfolios. Those are most appropriately benchmarked by comparing them to a public market equivalent, a PME. And all that is that you take a public market benchmark, something simple like the S&P 500, or it could be the FT Wilshire 5000, or it could be the Russell 3000. Those benchmarks, those indexes trade daily and are available on every trading day. So a measurement that is sort of the most pure measurement of just focusing on the success of your private equity program is to do a PME analysis, which we do for you in your private equity reporting. And what that analysis does is it takes every cash flow that you've had in private equity, whether it's a contribution or a distribution back. It takes the cash flow on the very day it occurred and places it in, hypothetically, in an index that you choose, S&P 500, Wilshire 5000, Russell 3000, places it in an index. And then over time, as those investments take their time, as they should, to produce returns, you're able to compare your internal rate of return to a likewise apples to apples internal rate of return of a public market equivalent, as if you put the same cash flows in public markets, and you can evaluate whether you are outperforming public markets with your private market investments or whether you're underperforming. So the key is, if you're doing that with your private equity program, all of you as an investment committee can know how you can measure the success of the program. That's what's most important. And if you're doing that, you can always stand behind that and know how well you're doing. But then on this time-weighted issue, you can neutralize that problem that you will often have, so that it becomes something you don't have to talk about at every board meeting. So that's, it's a recommendation for you to consider. We've done this with a lot of clients. And when you put the two together, you solve the problem at the total fund reporting, but you also make sure that the whole governing body and staff and the whole team has an appropriate way to understand whether the program is being successful. And your program, by the way, has been successful. In fact, we talked about that a little bit recently at the forum. So that's a recommendation for you to consider. Steve has touched on this quite a bit in the last probably 3 or 4 meetings. Some of those challenges that you have with the way these returns roll up.
Okay, well, thank
So it's a
you.
lot to digest, but any thoughts or questions? Happy to step in further.
I'm interested in whether or not any of the national organizations that set accounting standards for public entities have weighed in on this. Is it considered a best practice by auditors who would be trying to determine sort of the actuarial consequences of our private equity investments? Is it all speaking the same language, I guess is what I'm asking.
Yeah, that's a great question. There's been a lot of discussion about this for a number of years. And but what I can say is the IRR methodology, I could come back and source, who would say this, but the IRR methodology for private investments is the appropriate measure. But that's looking at the private investment program. So that's kind of where the opinions come out, is how should you measure the performance of private equity? It should be done on an IRR basis. And then how should it be benchmarked? Well, the best way to benchmark it is against a public market equivalent and do an IRR analysis. The problem that is probably a little more ambiguous is like the challenge that I outlined is, but when you roll up into total fund returns, you can't roll those IRRs up. You have to do a time-weighted return, which over really long periods, say 15 years or so, they start to converge generally. But in the 1, 3, and 5 year periods, it just has big impact that it is not really appropriate for you, as you look at it. So
I think you might be talking about two different things, David. For auditing, that doesn't change anything. This is just a benchmark for looking at how the program did, and the auditing is still going to be what it is. Like, so they value it every quarter, and nothing really changes there.
oh yes, for sure. Yeah, thanks.
And David, you mentioned, I think, the CFA performance standards. Have they addressed, I haven't looked at it lately on this subject, but have they addressed it significantly?
They've addressed it, Pruitt. I would need to look recently to see if they've sort of had any conclusive opinions on this, but they've talked about it and recognized, the challenge, I think, for, quite some time. So we could certainly come back with anything like that.
So this is more like the decision we made some time ago that went with a broader index for equities than we were previously using. Sort of identifying a better process by which to benchmark performance.
Yep. It's actually a return to what things were like before a certain person became our CIO a few years ago. So we're just going back to how the normal things were before that.
John,
There were changes made, and maybe there was more or less backup for why those changes happened. I think this is a recommendation, just go back to how it was. And to give it, and for concreteness, I guess, like the volatility of it, you can see it right now in our performance. Like, I think that for the 3-year return for private equity, the benchmark is 22. It's pretty high. If you turn to page 93, you can look at the private markets. And that's from Preqin or whatever, their returns for private markets overall, you can see for 3 years is around 8, 7 to 8 is your benchmark. Private equity 5, private capital 5. So 22 is just not really a good measure of how things have been in the private markets, but that's what we're measured at because that's a simple thing to look at. But like David said, that causes our performance to look a little skewed, right? So if you're benching to 22 and you have, what we have, which is still decent, then you look like you're way under, even though we're not. I don't think, at least our program is fine as it is. It just isn't, it isn't making 22 because nobody is. And so
that's right.
So that's kind of the issue. And so I think that's the rationale for just having the actuals for the first few years while things are still sorting out. And then the job we have is to really look at each fund that we have. And like David said about the private market equivalent, like what could we have done with that money? And would it be doing better than that? If it's not, then we've been wasting our time and fees with it, right? Obviously we can't know that ex ante, but that's kind of what it tells you, And so that's kind of how we've always been doing it. You compare it to what else you could do. We don't have to do any private equity, obviously, if we didn't want to. I mean, it's a lot of fees. The idea is that hopefully provide us a different stream of returns and a different way of accessing returns that are going to be different than the market, just public market, so we can get cheaply. But we don't have to do it, right? I mean, even the Wilshire optimizer would say 0 given the zero private equity, given what we have, if we didn't put our thumb on the scale. So we're always looking in the details of each individual investment and whether we should be doing it or not. So
That's really helpful.
John, I believe you have a comment.
Yeah, I do. Really more of a question. The discussion this morning has been on the benchmark to which we compare our actual performance. On our actual performance side of the equation, is there a consistency among the various investments we have as to the methodology of valuation?
So, John, do you mean asset class by asset class? Is there a consistency?
Well, just for the private equity in general, perhaps by asset class within that universe.
Yes, every manager values their own positions. So they have, you can, with your experience with them, you can, figure out how conservatively or not certain managers value things. That's something you can do in the diligence process. That's something you have actually when you have, several years of experience with them. There's some managers that I would say I don't believe their marks, and we've had that, and then we've been proven correct on some of those. And then there's quite a few others that market fairly conservatively, and when they monetize the positions, there's quite a big uplift. Actually, we're going to probably have one of those next year through the Bay Hills portfolio. We can just update everybody. There's one very large company that makes up a majority of the entire Bay Hills exposure, over 50%. And an agreement was signed to acquire it on Veterans Day, actually when we were out on holiday. Parker Hannifin is going to buy it. It's a filtration group. And there's going to be a significant uplift to the current mark that Madison's holding it at. I think Marty Murray, our financial expert and liquidation person, estimates it to be it's a significant gain in the whole portfolio as a pension. So it's pretty notable. So that in that case, you can see that Madison's probably holding at a more conservative valuation. Unfortunately, we see the opposite in some other managers. But in this case, I would say a lot of the ones we have tend to mark things conservatively, and then we are pleasantly surprised when they finally sell them. So that's going to happen next year. The target close is 3Q of 26. It's called Filtration Group, if you want to look it up. And Parker Hannifin, the public company, is buying it.
So, Anthony, do you actually see the formula that the companies use or the funds use to value themselves?
And you can talk to the companies and see how they justify it if you want to. But I mean, that's, we have dozens of managers with varying amounts of size. So obviously we follow some of the ones that are bigger, but we're important enough to probably be able to talk to folks. If you have any specific questions or valuations, happy to talk about it. Sometimes we have companies that are in the news. A few years back, we had WeWork. So I'm going to tell you that valuation fluctuated quite a bit. The folks that had that tried to sell as much as they possibly could. They still made, 3 or 4x on their money, but it was a lot more if they could have gotten more off before everything happened. But yeah, so that they are in our portfolio, and we can talk to managers and get more detail if you like.
Okay, thank you.
This whole industry is in the press about it, but it sort of fits the Warren Buffett's classic comment that when the water goes out, we find out who's not wearing bathing suits, and that's really the only at the 5 or 6 or 7 year mark, which is when the water flows out, more or less. You'll know whether they were fudging or overly optimistic on their market values. And but there has to be some sort of event, whether they sell each position, or whether they whether they just keep them on the books for a while. And there's a lot of that going on. But Mr. Buffett cut it right down to the the truth time.
Yeah, that's right.
I think there's a lot here, and I think there's a lot of merit to the third recommendation that Wilshire has developed. But I think we'll maybe have a special meeting just to talk about it ourselves, and then we can propose a shift in the benchmark and get that done here and after the first of the year. Does that seem reasonable?
Yeah, that sounds good. I think that would probably coincide well with the policy changes and improvements that Carrie's been making. So I think they'll all go well together. So, yeah.
And
Is
is
there
it
any objection to that track from our committee members?
No, not at all. I guess I'm interested if the same recommendation is being made to the C board.
Yeah, yes, it is.
Good.
Yeah.
I think given anticipating future reforms, the more we can be in lockstep on these kinds of reporting issues is good. So that's Mr. Chairman, that's one of the considerations I would have is that we have our CEOs test whether or not this looks like something both boards, all three boards, were willing to embrace.
Yeah, and we see no problem with you spending some time on it as well. I mean, we've talked about this in a few meetings, and it's a change, and it certainly warrants some discussion. So,
Okay, well, that's a very good discussion here, and I think we all learned a few things, and we will certainly not let this drop. We'll have some more discussions and be ready to formulate a recommendation. And this one, the investment committee will make a recommendation. We'll of course take it to the full board. Okay, any more discussion here on the benchmarking? If not, I guess since Steve's not here, Anthony, are you going to pick up the budget update?
Sure. Yeah, we can start on we'll just start with a quick update on the market performance of 76. Can we go to that page, please? This is just showing like how performance has been. As you guys might know, third quarter was a very strong quarter in the markets, like just equity wise. Our plans for the most part kept up. I think the S&P 500 was up over 8%. EM was over almost 11. Russell 2000 over 12%. So things were pretty strong. And so similarly, our performance as a plan were over 4%. The thing, in the kind of running market like that, it's difficult to keep up on the equity side, but I think we were fairly close. And private equity is the laggard, unfortunately, because they just aren't, the markets aren't going to change that fast. But it's a little more lumpy. But I think the rest of our portfolio, you can see, was quite strong and has been for the past 5 to 10 years on the credit and fixed income side, real estate and real asset side, in terms of being underweight some of those, but still the parts we have done well. And credit and fixed income has continued to do well. I think in large part ticket selection. Real assets, the main thing that has been strong has been our MLP allocation. That faltered a bit in October. I think that market was down a bit, but it's been still a very strong 5 years since the COVID sharp decline. We can keep going to let's see, 81, please. Over here, you can see, sorry. Is that on the right one? There should be a page for allocations. I'm not sure if that's it.
I think that's page 93 on the
I must have
version
an
3
old copy
doc.
there.
Yeah, there were several versions of the doc. So.
Yes, that one. Thank you. This one just shows, things are in line, in the ranges. So we still have a little bit underweight to real assets and real estate, and but real assets, that's been the gap of that is closing. We had a call for not for the K plans for the football fund, but our barge leasing and rail car funds have fully called their capital, or started to call the barges have called their second part. Rail cars fully called, and so we are seeing some more deployment there. Our farmland manager was acquired by Wisdom Tree, and they also took in some capital before they're going to close the fund that we're currently in. So So that is some additional deployment that we've been doing there. All right. If you want to go to, I'm looking for the universe slide. It was page 115. I'm not sure if that's still it, but we can see. Maybe a couple more further. Yeah, sorry.
Universe slide, Anthony?
It'll be the plan sponsor peer group analysis. It's a couple more.
Right.
after this.
Yeah, let's see.
127.
Thank you. Sorry, I have an old version of this. Sure. Yes, there we go. Okay. So this just shows, yeah, I think for the K plans, we've had top quartile returns and top decile Sharpe ratio over the past 5 years for the more funded plans. This one I think is this is the K and the S pensions. The 5-year percentiles look a little lower because we took lower risk. But you can still see it's well above our benchmark, 852 versus 796. If you go to the next page, that one, yeah. So for 5-year returns, we're at our benchmark, which is top quartile there, and Sharpe ratios have been top decile for getting the most reward for the rest that we've been taking. And so that's where we are for now. I think happy to take any questions. And
Maybe
I'll just say,
Anthony, I was just going to point out on the prior page, you'd mentioned the returns being a little bit lower. And you mentioned the fact that we're taking less risk. If you look at kind of on a bang for your buck, both on the standard deviation and the Sharpes, they're top deciles really. So given the risk we're taking, the portfolios are performing well. So.
I think that's why Steve usually says this is one of his favorite slides, right? It really pulls the whole picture together. Return on its own doesn't tell you, the whole picture of how the returns are generated.
Right. And given our positions, we aren't gonna, take as much. We can't take as much risk as maybe we can in other account in our personal accounts that may have less liabilities or different things. So this is the way that we want to do things to meet the needs of our members. So that's what we're trying to do.
Well, I think this slide always sells well with the PPOB to the extent that a few of them can actually read it.
Well, we'll give trying to explain.
Or they can.
Yeah.
A few of them take the time to do it, I should say.
Yeah.
But it is very important that their confidence continues to build in what we're doing and doing it on a very strong risk-adjusted basis. Any more comments on these, on Anthony's numbers or Wilshire's numbers? If not, I believe we have Carrie standing by to compliance review.
Thank you.
Hello, good morning. I'll keep it short and sweet. Everything is looking good for the quarter ending September 30th, 2025. All guidelines were in compliance. Nothing to report exception-wise, and proxy voting reports are up on the website in compliance with statute. Anyone have any questions for me? All right. Well, I appreciate your time.
Thank you very much, Carrie. And as we those of us have been at these reviews a long time, and David has prodded us to do it better, and we certainly are now with Carrie on board. So if there's nothing else, I guess we have reached always popular item number 11, the adjournment. And I would ask for a roll call, but we're not going to do that. This meeting is adjourned.
All right. Thanks, everybody.